Okay, welcome guys. I'm going to do a midterm review for you, and what I've done is I've put together a comprehensive 300 slides of all of the material that we've done so far, and you can use this as a reference for the midterm exam. The midterm exam is going to be deployed fully online, and it's going to have a set of multiple choice questions and some short answer questions, and the test is going to be timed, so whenever you start the test it's gonna automatically time out in 2 hours. So that's how you want to plan. Whenever you're ready to take the test, I'll give you a window of a couple of days of when you can start and finish the test. Okay, so the first thing we did was an overview of fintech, and when it comes to this part of the lecture, we only want to focus on what the definition of fintech is and what are the reasons that the fintech is happening now. So the reasons of why fintech is happening now is a combination of advances in technology that led to better evaluation of people's data. Okay, so for example, you can do better credit risk analysis because of big data. The second factor is what happened with the global financial crisis, so the economic circumstances. So you want to go over a bunch of things that some of the regulations that were passed. For example, for equity crowdfunding, Jobs Act came after the financial crisis, so you want to be able to address those issues. The low interest rate lending environment and sociological factors, for example, use of 3G technology in mobile phones and the preference for online activity by millennials. So you can compartmentalize the factors into 3 components. Okay, then we move on to online marketplace lending. In the online marketplace lending, again, you want to be able to, so some of the things that you can get questioned on is a bank balance sheet, what are the sources and the uses of funds by a bank, and how a management of credit risk, okay, so which is essentially the loans, how a bank does credit risk analysis. Okay, so you want to be able to focus on these things. I don't have it here, but you want to be able to pay attention to the bank balance sheet, which you have in the original slides. Okay, so what is credit risk analysis? What are the 5 C's of credit risk? Okay, character, capital, capacity, conditions, and collateral. Okay, so this stuff can show up in a multiple choice, as you saw with the quiz that I gave when we worked on this part of the lecture. Okay, and of all of the C's, the most important is character. Okay, which factor contributes the most to a person's credit score? And you can see from this pie chart, 35% is payment history. So that's how we want to be able to establish a recall on what is the most important factor for a credit risk. The average credit score for the US is 670, and it ranges from 300 to 850. So we want to be able to remember that because this is going to show up in a multiple choice question at some point. Alright, moving on. So we establish banking is important. I've been talking about asymmetric information and how it's composed of 2 things, moral hazard and adverse selection. What banking does is moves money from savers to borrowers, but people have lost trust in banks, so now we've created space for another player to offer banking services. Okay, so banking is necessary, but we don't really need banks to do it. Okay, so this is when this is how we create space for talking about Prosper or Lending Club or peer-to-peer financial intermediaries. Okay, so one should be able to define peer-to-peer lending. It is the largest of the peer-to-peer lending is the consumer unsecured market. Okay, so you need to know what unsecured is, what are consumer loans, what are the other kinds of loans that you could get. Okay, you could get a mortgage loan or a student loan or a small business loan. Okay, so when we're talking about the kinds of loans you can get, we want to know what are the players in those markets. So that's one thing that can come up. So
key features.
This is an important slide.
Like
what are the key features of peer-to-peer lending,
and what the key features are of peer-to-peer
lending, or even a multiple choice. From here we move on to this specific slide. Here you want to pay attention to the aspect that peer-to-peer lending is mostly used for debt consolidation. So we care about this issue. How important is peer-to-peer lending? We want to highlight that a peer-to-peer lending, the consumer business loans they take up 12% of the market size, and this number went up significantly in 2018. So I don't have the statistics, but we want to pay attention to this. Moving on, I'm not specifically attached to this slide, so we don't have to pay attention. So here we want to, like I said, talk about the various players in the peer-to-peer lending market. So some of these have moved on to doing other kinds of loans. For example, Sophie does not just confine itself to student loan, but like the broad categories of their core business, you can get questioned on this. So the key punchline of peer-to-peer lending is how the peer-to-peer lenders evaluate borrowers' creditworthiness. So a big focus is going to be on this aspect. We want to know, so essentially the objective is to reduce asymmetric information. The asymmetric information can get reduced by acquiring more information. That more information, it's easier if it is hard data as opposed to soft data. For example, interviewing people, feeling that you can trust them, so on and so forth. So banks largely focus on trying to acquire hard data. Okay, so if you are able to codify the soft information, then you can use it to your advantage, which is what peer-to-peer lenders are able to do. Okay, so we go through Prosper. I would expect you to know these specific data on Prosper. For example, 3-year unsecured loans, what is the maximum amount of money you can get, and what are the various things you can do on Prosper to disseminate information about yourself so the prospective lenders feel comfortable bidding on your loan. Okay, and what are the various rating categories, which are very different from a FICO score. Okay, anyways, so all of this stuff is important. I won't go over every single detail. These are the various standard banking type variables. They are called hard information, and these are the soft information variables. For example, HTML character length, what story you're telling about yourself, so on and so forth. And as a result of all of this, this alternative information that the peer-to-peer lender is able to collect because of big data, okay, so they are able to come up with their own rating grades, and in some cases these rating grades are superior to simply a FICO score. Okay, so Prosper says that FICO score is just one component of 500 data points that they use to come up with a rating grade for their borrowers. Okay, so we care about this. Most of this stuff can show up in a short or a multiple choice question. And there are two kinds of business models: the direct lender model, where the lender will hold the loan on their balance sheet, or the platform lender model, where the loan is getting originated through a fronting bank. And fronting bank for Lending Club and Prosper is WebBank. So in this case, the platform lender does not hold the loan on their balance sheet. So it's a originate to distribute model. And I'll probably ask you about this. Alright, so I'm going to move on from here. This is the statistic where they're trying to show that fintech lenders represented 3% of the loan market, consumer loan market in 2010, and this number jumped to 20% in 2016 or 17, or 30%. So, important. Alright. This, we're just talking about the comparison between FICO score and the rating grade assigned by peer-to-peer lenders. Okay, so I want to move on from here. You can know what the consumer, the student loan market or small business market is like, the various players. Here we go over the benefits and the risks of peer-to-peer lending. I will let you go over these slides yourselves, but this is the kind of stuff that can show up in a short question. Okay? All of the slides are fair game as far as I'm concerned. Then we go on to equity crowdfunding. Here we are talking about a different kind of financing. So we are moving away from debt, which is fixed claim, tax deductible, high priority in financial trouble, and with fixed maturity and no management control. So all of these are very attractive features, but you cannot get too much debt, and the more debt you get, costlier it gets. So as an entrepreneur, at some point you have to move on to other sources of financing if you don't have enough money. So what is the other source of financing? It would be equity. So equity is more risky because it's a residual claim. You only get what's left over. So if your business doesn't make money, the shareholder doesn't get anything. In addition, if you're an entrepreneur and you're trying to raise equity, which means you're getting other shareholders, then the more number of shareholders you get, or the higher percentage share they want in your company, would translate into losing control of the company. Okay, so two distinct characteristics, so two different kinds of claims. Okay, so the entrepreneur at some point has to think beyond debt, because you cannot have unlimited supply of loans. So again, the contracting issues around how you go about getting more number of shareholders center around how you mitigate the information asymmetry problem. Okay, so a guy who has a new idea, maybe it's innovative, and he probably has a very hard time trying to explain how good the idea is, and therefore it is harder for him to make people see how valuable the ultimate product is going to be. Okay, so that's information asymmetry, that you know more about your product than others. Okay, so for a startup company, there are various stages. So whatever the age of the startup is, that's the kind of financing options that they can explore. Okay, so here, for example, if you're a growth stage 1 startup, it's hard for you to get external financing. Okay, The most you can do is get bank debt, but there is limited supply. So what do? You try to find a VC who can give you money. Okay, so you can look at the age of the firm and you can figure out what is the menu of financing options available to them. Okay, so it's kind of the same stuff. So for an entrepreneur, various options are VC, angel, and then eventually to go public. So angel comes before VC, so we want to pay attention. So there is another source of what we're trying to do is we're trying to formalize that you could get money from your friends and your family members. So we want to create essentially we want to do it in a more formal contractual way than it has been done before. Okay, so the friends and family is where a lot of the equity crowdfunding is going to come. Okay, we go through what a VC is and what a VC does, what kind of financing you get from a VC, and how does VC make money on their investments, usually through either getting another company to acquire this company, the startup, or doing an IPO. Okay, so I would definitely pay attention to what a VC does. Not a whole lot on this topic, but it's sort of relevant. So the stages of growth that we are focusing on is the early seed startup stage. Okay, so there's a multiple choice question that you saw before. It can show up. VC would tend to show up in the expansion stage. So we are trying to create an equity crowdfunder at the startup early stage of a investment. Okay, so we go over exactly what crowdfunding is. Small question on this. Okay, we have identified where the funding gap is, so where are the major players. Okay, and finally we want to, as we are moving forward, we're going to start making a distinction between what's it called, equity and non-equity crowdfunding. So first we lay out, I'm gonna move on from here. All of that stuff is important, but you can read it yourself. So we can move on from we can compartmentalize equity crowdfunding into equity-based and non-equity based. So what do you get when you are doing a non-equity based crowdfunding? Essentially, we are getting crowd donations or some kind of reward or recognition in a non-equity based crowdfunding model. A big advantage of doing non-equity based crowdfunding is the pre-sales, where you are testing a product when you promise to the people who are giving you money that I will give you a sample product when it's released. Okay, so crowds pre-selling, it's also doing a simultaneous market research. So how we understand marketing and shareholders and consumers in a traditional context becomes a little bit blurred when we're talking about equity crowdfunding. All right, so that's what we want to talk about, the equity and the non-equity, and essentially go through the limits of how much money you can invest in a equity or non-equity based funding platform, and also the limits on how much money you can raise. Okay, so it is largely unregulated, so there are limits on how much risk an individual investor should be taking. Okay, so we move on from here. All of this is important, and this just talks about the early research on non-equity crowdfunding. Again, when these things show up as a essay-based question, it is okay to just list it. You don't have to do a lot of writing, because in 2 hours you won't have a lot of time to write stuff. Okay. From equity based to, okay, I've been just talking about this, so this is fine. And this is important. Crowdfunding platforms, equity crowdfunding, have to go through an SEC registered intermediary, okay, or through a broker-dealer funding portal. So, like we've been saying, we are trying to formalize the friends and family level of equity capital, okay. We'll go over, so this is a pretty fair essay-based question on what are the benefits and the drawbacks of equity crowdfunding. Okay, then we look at the two business models. One is the keep it all and all or nothing. You should definitely know the distinction between these two. We discussed like 2 or 3 platforms in detail here. So this kind of stuff can show up in a multiple choice. So what kind of INDIEGOGO, does it do both KIA or AON or just one? Then what are the different percentage cuts that INDIEGOGO will take based on whether or not you launched an all or nothing or keep it all campaign? Okay, so why is the fee higher for a keep it all campaign where you don't meet your funding goals? Okay, so one of the reasons why that's obvious is if you're trying to bring a bad idea to the market and trying to raise money, then the penalty is higher. Okay, so this is just to discourage bad players. So you can link it back to adverse selection. This is how we discourage bad players to come to the market. Okay, so again, it's always going to tie up into some kind of an asymmetric information issue and how we are trying to solve either moral hazard or a adverse selection problem. Okay, so it's helpful to think this way. Moving on, just go into INDIEGOGO in a bit more detail. I won't focus on Kickstarter, but I will talk about Sellaband and Crowdcube, essentially, because these are the 2 players we discuss in a formal equity crowdfunding. So how you go about creating a contract, so trying to mimic a typical shareholder agreement in a peer-to-peer crowdfunding format. Okay, so the kind of fees that Sellaband will charge, and does the Sellaband share owner behave like a typical share owner? And the answer is no, because the share ownership disappears after 4 or 5 years, as opposed to a typical shareholder who is a shareholder for the rest of their life, unless they sell the share. Okay, moving on, we go to Crowdcube, and this is more formal, and I'll definitely talk about what I would like to focus on in Crowdcube is this idea of, if you make a bigger investment, one of the things that you could do is negotiate on the value of the startup. And the reason why I care about this is it's another way to do price discovery, which in a traditional sense you would do by doing roadshows in the IPO circuit. Okay, so again, it's important. All of the slides are have been downsized from a set of 600 slides to 300 slides. And if you were to actually move all of this data into a Word, you won't have a lot of material. So it looks overwhelming, but it's a pretty reasonable set. Okay, so We talk about Crowdcube a little bit more, and then we move on to automated wealth management, which I will do in the next video. Okay, so now we talk about automated wealth management, also called Robo Advising. So in here, the original slides include a lot more information on Betterment. I edited those slides just to focus on first, what is portfolio theory, which is the fundamental mechanism through which robo advising is conducted, or that's the underlying foundation of robo advising. And then we're going to talk about what various robo advisors do. Okay, so it would be helpful as far as these couple of players are concerned, what the minimum investment is. And I think Future Advisor is not 0, so you might want to cross-check that. Okay, Betterment is 0. So the key theory is the portfolio theory, which was introduced by Harry Markowitz, for which he won a Nobel Prize. And portfolio theory is a theory about how, as you keep on increasing the number of securities in your portfolio, the relationship between the risk and return of this specific portfolio. So the risk and return are the only two criteria that determine whether a portfolio or a combination of securities should be invested in or not. Okay, so when we talk about risk and return, in the mean-variance, variance represents risk and mean represents return. Okay, so we are doing a risk return optimization exercise. So what is a portfolio? A portfolio is you can think about a portfolio in two sub-portfolios. The first sub-portfolio is a combination of risk-free investment and a combination of risky investments. Within the sub-portfolio of risky investments, you can get different kinds of risky stocks or bonds. Okay, so the first decision you make is dividing between risky and risk-free, and the second decision you make, what kind of risky. Okay, the investor preference for risk, which is likely to be different for a 80-year-old as opposed to a 20-year-old person, will kick in at the time where you're trying to divide money into risky and risk-free. So the older risk-averse person would put more money in the risk-free asset. Okay, so how would this, if in a traditional sense, this would translate into you as a wealth manager trying to talk to a client and trying to figure out, well, what is my assessment of how much risk they want to take? And in a robo advising context, this would get implemented through a questionnaire. And we'll see in a later slide, Wealthfront does this whole set of questions just trying to determine where they think your risk preference lies. Okay, so that's the whole investment decision that a wealth manager or a robo advisor will make. And the moment you log on to the app, they will give you a 90 to risky and 10% to risk-free allocation. So when they are talking about risk-free, generally they will invest in money market mutual funds or in treasury bills. Okay, moving on. So the reason why all of this works is because there is a kind of risk that you can eliminate by adding more number of securities into your portfolio, and that risk is called the firm specific, unique, idiosyncratic, unsystematic, non-diversifiable risk. The risk that you cannot eliminate is market, systematic, non-diversifiable, sorry I said, and yeah. So we want to know the definitions of these two risks and what they're called. Okay, so the reason why this works is because of the relationship of how mathematically the risk and return are calculated. So when we're talking about return, it's simply a weighted average. So how much money have you invested at what rate of return? That's the return of your portfolio. But the risk of a portfolio, when we try to do the maths around it, turns out is a component of the variances of individual securities and the covariance. So when the covariance is negative, it shows up with a minus sign in the third part of this equation, and the effect is that it reduces or it takes away from the individual variances. So this impact of taking away from the individual variances, it has the effect of reducing risk of the total portfolio, and this is why we want to add as many securities as possible to our portfolio. Okay, so no math but concepts around this issue. And the covariance, even we want to look at the covariance number in a more relatable way, we can turn it into a correlation coefficient. The correlation coefficient essentially goes from -1 to 1. So we want the covariance to be low or minus, ergo preference for either 0 or negative correlation. So as long as it's less than +1, it's a good thing. Okay. All right. So what we end up doing is we create these risk return profiles of our stocks, where, as you can see, ER is on the vertical axis and sigma is on the horizontal axis, and our preference is to have higher ER and lower sigma. So we are moving in a northeast direction, up and left. Okay, and anything below the global minimum variance portfolio is an inefficient outcome, because for the same level of sigma you can get a higher return. All right, so you don't really have to pay attention to this. Except that you need to know what the capital allocation is. It's the point on the global minimum variance portfolio, P, which gives you the highest return for a level of risk. So the definition is ER, which is return, minus RF, which is the risk-free rate, divided by sigma. Okay, so so that's the point you want to choose, because right now here it represents a lot of points, so you don't know how you want to divide your securities. So therefore, how you should divide your securities between various risky assets is a purely technical exercise, and it's the point on the curvature that gives you the highest cal. So the cal is the reward to variability ratio. You have the formula in the original slides. It is also called the Sharpe ratio, and there'll be you have seen sample math questions on it. I can ask you. Okay. All right. This, we did the portfolio visualizer exercise where we can select a bunch of stocks, and you can see the expected return and standard deviations of various combination of assets. All right, so and that's the optimal portfolio on the website. Okay, so this is also called the efficient frontier. So you could on your own try to figure out, you can do this portfolio maximization exercise, and you could figure out which stocks to invest in, and as and when stocks go down in value, you could dump those stocks and acquire new stocks based on whatever optimal portfolio you come up with, and that's called active management. Or you could simply just mimic the maximum possible combination of stocks that are already existing in the market. Okay, so that's passive management. And for passive management, you can do what's called an index fund or an ETF, which is an exchange traded fund. And these passive managements do not require you to, these index funds don't require you to constantly do portfolio optimization or constantly rebalance, which means when you're selling and buying new stocks to keep your portfolio at the highest sharp, you are incurring brokerage commissions, so those are costly, and this is why you remove the rebalancing costs and hiring someone to do the maximization exercise, so management costs. Since those costs go down, index funds tend to be cheaper. Okay, so why do we bother with passive indexing? Turns out that passively management funds tend to outperform the actively management funds. In fact, the actively managed mutual funds never or don't consistently beat the market. Okay, so why not just invest in the market? And one representation of the market is the S&P 500. So any kind of index is essentially a representative of the market of those kinds of stocks. Okay, so if you just mimic the index, you get the index fund that mimics the market. So that's the intention. And so there have been lots of studies that have consistently established how passive investment is superior to active investment. And these bunch of slides basically detail what those studies have said. And the same holds for bond market. So Lehman Bond Index is the index of bonds, and actively managed bond funds are less profitable than the market itself. Okay, so holds true for stocks and bonds, so why not just do passive management? And if that's the case, you don't need a mutual fund manager, you could just do it through some kind of a algorithm. Okay, and some data on, so Spider NAV, Spider is a mutual fund, index fund based on the S&P 500. So the returns on the mutual fund and the market are fairly close. So now that we have made the case, we move on to Robo Advisors that use mean variance optimization for the most part to invest entirely in index funds. Okay, so the various players, and essentially they offer you goal-based investing. A goals-based investing is letting a client or a customer create two different kinds of sub-portfolios based on different kind of risk preference levels. So for example, I have this money, $5,000, that I want to use just to experiment, and if I want to just experiment, I can take more risk. And the other $10,000 is for my college education or for my child's education, so which means I don't want to take a lot of risk. So I could create these different human beings don't have a standard level of risk preference. Based on the goal, their risk preference changes. Ergo, you can create portfolios based on what your goals are. Okay. These are the various players, their minimum, and what kind of fees they charge, and how this is different from a typical wealth manager who will charge 1.35, and you see most of these fees are fairly low. So again, in terms of the kinds of robo advisors you will get questioned on, we'll confine ourselves to Betterment, Future Advisor, Betterment, Wealthfront, and Charles Schwab. Okay, so this is the robo advisor methodology. These are the questions that you sort of messed up in the quiz, so we want to pay attention to what this methodology entails. So asset class selection, okay, then asset classes are different kind of portfolio of stocks that have special characteristics. Okay, you can have a growth stock that would include Facebook, Snapchat, a growing company. You could have an income stock that gives you dividends. Okay, so these are asset classes. So within the growth, you could have mutual funds that mimic a specific index. So the investment vehicle selection is specific mutual funds within that asset class category. Okay, then the robo advisor will construct optimal portfolios. The optimal portfolios, for the most part, are constructed using mean variance optimization, which you know what it is right now, and they are only creating portfolios of already diversified index funds. They don't do specific stock investment. It's just a portfolio of various index funds. Okay, so they do risk tolerance assessment and then ongoing portfolio management. Okay, so now you know what asset classes are and what are the various criteria that are used by the robo advisors to figure out which asset class to invest in. Okay, so you can get questioned on this. Okay, what are the various asset classes you should know? The various EDFs within those asset classes. Okay, and how we go about figuring out which ETF we want to choose. So the criteria, you want to choose ETFs that are not new, you want to choose ETFs that are not leveraged, and you want to choose ETFs that have lower benchmark tracking error. Okay, so we want to know the definition of a benchmark tracking error. Okay, all right, so and these are the various primary ETFs used, and you can see the specific name of the ETF under the asset class. Okay, all very low expense ratios. Okay, and the correlation between the ETF and the market is extremely high. Okay, so you are essentially investing in the market. All right, so how is the robo advisor investing? So we've only talked about portfolio optimization, so I'm not going to focus on other things such as the Black Litterman or the CAPM model. Okay, and yeah, moving on. So when you did the portfolio visualizer, you saw a lot of the times that the portfolio visualizer put all of your money in one stock. So we want to avoid that constraint, so we can set a limit of, well, whatever the optimal portfolio is conditioned on the the maximum allocation of say 35% to growth stocks. So you can set these limits. You saw a multiple choice question on this, but you need to know what this actually means. Okay. The customer risk, we have one example, which is the wealth fund questionnaire. And so I can ask you, what is the purpose of the wealth fund questionnaire? And the answer is to determine client risk preference. Okay. And finally, what kind of ongoing management they do. They do two kinds of management. One is called rebalancing, and you rebalance when you get portfolios that have drifted away from the original intention of the entrepreneur, of the investor. Okay, that's called portfolio drift, and the portfolio drift is corrected by dumping stocks that no longer dumping mutual funds that no longer meet your investment objectives. You could do this on a timely fashion at regular intervals. That's called calendar rebalancing. Or you can look at the market value or the risk return characteristics of your objective and the portfolio and see how much the portfolio has drifted away. And there are ranges. So Betterment has a 2% tolerance. If it becomes 3%, they will rebalance. Wealthfront tolerates a 4 to 6% portfolio drift. Okay. And finally, the Robo Advisors will do what's called tax loss harvesting. Tax loss harvesting is essentially taking advantage of the IRS rule that you can offset $3,000 of a capital loss. So you can reduce your tax liability when you reduce your income by, let's say, because you experience a loss. Okay, so this example goes over of how a typical tax loss harvesting strategy is implemented. Yeah. So because the ultimate objective is to realize a loss but stay invested in that asset class. If you realize the loss, okay, so how are you realizing the loss? By selling the ETF. But you want to invest in that ETF because that's your investment goal. So it won't work if you invest in the same ETF again. So it cannot be substantially identical. If you do that, it's called a wash sale rule. So you don't actually get the tax benefit. So either you wait 30 days to invest in the same ETF or you don't get the tax benefit. So why would you keep your money lying around for 30 days, which is called the cash drag? So what you want to do is not invest in the same ETF or a substantially identical, but you want to invest in a highly correlated ETF. Okay, so sort of a loophole in the IRS rule that allows you to invest in a correlated ETF, but not exactly the same. All right, so how do we identify correlated ETFs? Most of these robo-advisors will maintain a set of secondary ETFs. I don't know where it is, but it's on the other slides. And this is also called the parallel position management. Okay, so that's it here. And people have been able to, so it's hard for wealth managers to constantly screen for tax loss harvesting opportunities, but it is easier for algorithm to do this, and all of this has resulted in an additional 1.08% after tax returns. That's a lot of money, so making 9% as opposed to 10% makes a huge difference. Alright, so now I'm gonna stop, and the next slide is gonna be machine learning. All right, so now we're gonna talk about machine learning, and I understand there are lots of concerns around machine learning, but the kind of stuff that you'll get tested on is not very difficult. Okay, so we really need to focus on trying to identify what a data structure looks like. Okay, so trying to understand the difference between continuous, discrete, and binary observations. So you need to know the definitions of what these are. You also really need to know, and you will get tested on this for sure, of what is a y, which is the left-hand side variable, also known as the dependent variable or a predictor. Okay, and what is the right hand side, which is the independent variable or the single or multiple x's in a regression equation or any kind of relationship that we are trying to examine. So there are various names that come for the y's and the x's depending on your field of research. So a software programmer would call them attributes or features, whereas an econometrician will call them the dependent and the independent or explanatory variables. So I would expect you to know the difference between these. Okay, so machine learning is different from a traditional statistical analysis because we are trying to split our data into training and test samples, where in the training data set we use to create a model, and then we use the model to make predictions in the test data set, and our objective is to get the predicted values from the training data model as close as possible to the actual values in the test data model. Okay, and the difference between the predicted and the actual y's is the error. Okay, and the objective is to reduce this error as much as possible. Okay, so again, all of these things highlighted in green, you need to know what the definitions are. Okay, so like I said, we want to be able to create a training versus test data set, and the training data is used to develop a model, which is what we call learning the mapping of f, and the test data is used to test the model. And if the model tests well, we can use predictions, make predictions about the future. So for example, if we have come up with a very good model of trying to discriminate between a good or a bad borrower, we can use that model to, in future, reject loan applications for people who we think are bad borrowers. Okay, that's how we're going to use this model to make decisions in the future. Okay, all right, so the machine learning can be compartmentalized into supervised and unsupervised. Most machine learning is supervised. Okay, in supervised learning, you have a intended outcome that you want to examine. Okay, I want to figure out whether this is a strawberry. I want to figure out whether this is a bad credit risk borrower. Okay, so there is an outcome y in mind, and then I want to figure out this outcome y based on a set of explanatory variables. So in case of strawberry, I can come up with some features of a strawberry, and in case of a bad borrower, I can come up with things like their debt to income ratio, whether they're a student, etc., etc. Okay, so there are x's and y's that are already known to you. Okay, and you just come up with a mapping function or the relationship between the y and the various x's, and keep on improving the model, which is the stuff we didn't cover of how we do the learning, okay, and then implement the model. So there can be two kinds of stories that we could be interested in. We could be interested in a yes or no kind of outcome, or we could be interested in, well, if I advertise, what are the level of my sales? So it could be a discrete outcome. So if it's a yes or no, we call it a classification problem. If it's just how much more, then it's a regression problem, okay? So that's the graph. And so we spend like a lot of the machine learning math questions or interpreting output questions are going to be on the linear regression, okay? So unsupervised learning, you don't have a why, you just have a bunch of data and you don't know what you're looking for, but all you know is there are patterns and I don't know how to find them. So you could have Looney Tune characters and you can run a machine learning algorithm on it unsupervised, and it would, based on its own ideas, classify them or cluster them into different kinds of animal groups, okay? So you're not telling machine learning algorithm to do something specific. So you only have the x's, but you don't have a y, okay? Again, it's gonna show up on the test, okay? So mostly we do clustering and association in an unsupervised algorithm. So what are the definitions of under and overfitting? Overfitting is within the training data set if the model has a very low error rate, but it doesn't perform very well in the test data set. Underfitting is within the training data set, the error rate is very, very high, which means that there is no x's that can sufficiently explain some outcome y, okay? So what is a measure of good fit is when from you use the x's to get a predicted y, and the difference between the y and the f hat, which is the predicted model, is your mean square error. We sometimes square it because if we take absolute values, they will cancel each other out, so we don't get a decent measure, okay? So the mean square is, you could either take a square root of this, that would be root mean square error. We could not take the average, that is residual square error. So 1 over n signifies taking an average. So just 3 different kinds of interpretations of the same idea, okay? So the key machine learning algorithms are linear logistic, LDA is linear discriminant analysis, KNN, and tree. So within tree, we're gonna not cover the bagging, random forest, and boosting. So even though you ran these algorithms when we did machine learning in R, I think it's too much, so we can skip it for now, okay? So the linear regression is when the relationship between the y and the various x's is a straight line, that's it. And what we do is we do a ordinary least square model. So what you're trying to do is you're trying to come up with the deviations of x's from their respective mean, okay? And then you come up with the covariance relationship. So everything else aside, what you will eventually get is a relationship that looks like the 4th bullet point, where a y is a linear relationship with some intercept beta 0 plus some beta 1 multiplied by whatever value of x, okay? So that's a linear relationship. And turns out what we are trying to do is we are trying to fit a straight line that is closest to the various actual observations of y, which are all of the red dots. Okay, so the blue dots are the predicted values of y, and the red dots are the actual values of y, and the objective is to get the smallest distance between the line and the red dots. So what is the solution? The solution is the various betas you get. So those betas are going to fit the tightest line, okay? And that's the linear relationship. And so here you see y1 minus beta 0 minus beta 1 x1 is the fitted value. So if you were to just do beta 0 plus beta 1 x1, you will get y hat. That's what this slide is showing. And this is the correlation between the x's and the y's. Okay, so what beta really looks like, beta is simply a covariance of x and y. Alright, so you need to know what the intercept and the slope is in terms of math. You need to be able to come up with the formula for r squared. Okay, and if I give you a regression output like this, you should be able to write this into a regression equation. So in here it looks like the intercept is 7.03 plus 0.0475, which is beta 1 multiplied by x. So given this regression equation, if I give you values of x, can you give me a value of y? All right, so as far as the math is concerned, we are going to confine ourselves to the calculation of r squared and to estimating y hats or RSE. Okay, and that's fairly straightforward. R squared is another measure of goodness of fit in a linear regression model, and R squared is also called the variance explained. Okay, so these things, they're just trying to implement a linear regression in an Excel framework. They also give you the formulas. Okay, so here, for example, if for a given value of x, so the betas are always going to stay fixed, and if I tell you x is 182, can you tell me what y, which is the weight? Okay, and you should be able to do this. So there are a couple of problems where we give you some story of what the regression equation looks like, and we'll try to ask you what is the height of a student if the average height of parents looks like this. All right, so that's the math on linear regression that you expected to know, and we solved this problem in class and it was fairly straightforward. Okay, so from the fitted values you can also come up with the error. Here the error is u hat, and it's the difference between GPA and the predicted GPA. Okay, so moving on. In classification we did logistic regression. It is the same as linear regression, but here we are talking about generalized linear models, and we just want to collapse the y between a 0 and a 1. Okay, so we can use a transformation that will help us get the value of y, because we are interested in no, which is 0, or 1, which is yes. Okay, so if it is higher than 0.5, then it's a yes. If it's lower than 0.5, it's a no. That's what we want to do. Okay, so the dependent variable is either going to be a 0 or a 1. These are called category or class, also called binary variables. Okay, so various examples of what these questions would look like. So based on your data set, you can very quickly figure out whether this is a regression or a classification problem. All you have to do is look at what the dependent variable looks like. Okay, so like I said, we're gonna transform it into a sigmoid function. This is a generalized linear model. Okay, So the relationship is linear in nature, except that it's sitting on top of a e, and that makes it slightly non-linear. Okay, so we can figure out what the probability of something happening is based on e raised to the power of the beta equation divided by 1 plus e. Okay, so when you do the math around it, you will get something like 0.65 or 0.75, and that means 75% probability of something happening. Okay, and then again we take the regression equation, put it on top of e's, and we can come up with some prediction of y. So in this case, the prediction of y is 0.00004. It is less than 0.5, therefore it's a 0. Okay, then you can look at the actual observation whether this was it was a 0 or a 1, and we had coded zeros as males and 1 as females. All right, so then we go through a bunch of different examples of the probability, and that pretty much concludes the math part of what you can get tested on. So Sharpe ratios, y-hats, r-square, and RSA. That's it. Okay, and the probability in a logistic model. All right, so the linear discriminant analysis, pretty much all you have to pay attention to here is you used LDA. It is like logistic. It tries to do the same 0-1 kind of problems, but using a non-linear method called the Bayesian method, and you're just trying to find out conditional probabilities of something happening. And you do linear discriminant analysis when you have more than 2 categories. Okay, so red, white, blue, but that doesn't mean that you cannot do LDA on 2 categories. But if it's more than 2, that's the option available to you. Then we did the k nearest neighbor, and all you're trying to do, also called lazy learning, and you are trying to put things in categories, but basically if they're looking at how close they are. So in here, the green dot is closer to the blue dot than it is to the red dot, so we are going to classify the green dot moving forward as a blue dot. Okay, that's the k nearest neighbor method, and it is trying to estimate the Euclidean distance. Okay, so when I'm using the word Euclidean or generalized linear model, things like those that you don't really know what they mean, those kinds of stuff will show up in multiple choice. Okay, so KNN uses what? So you need to know KNN uses Euclidean distance. Okay, so in terms of KNN, not a lot of math involved, but for example, this specific slide is non-parametric, lazy learning. You don't actually have a model in mind, so that's what's called non-parametric. Okay, you just let the data figure out what category. Okay, so KNN can be used for regression or classification problems, and we don't need to know the math around it, but one of the interpretation of a problem is, so ultimately the objective is to reduce the mean square error. So what value of k reduces, how do you choose how many neighbors? So you make that decision based on the lowest mean square error, and in this case it is likely the value of k is 3. Okay, so that's how we decide which model to pick. All right, so in terms of trees, you need to know the basics of trees, what they're called, what they're used for. Okay, and what they do, they partition data based on, again, the lowest error. Okay, and essentially the theoretical, what we go through in these bunch of first few slides. Okay, So here, for example, so one of the questions related to trees was what you saw in the multiple choice questions, where you had to arrive at a decision based on, essentially you had to go through the tree. Okay, so those kinds of questions you can get asked on trees. Alright, so like I said, we're gonna skip the bagging boosting. You need to know what unsupervised learning is. Okay, and the next set of questions in terms of R, I will not make you do R on the test. It's not possible. But what we can do is we can give you an R output. For example, this is a linear model. As you can see, linear model formula equals MEDV equals LSTAT. Okay, so I can ask you to identify the intercept and the beta coefficient in this regression output. That's the kind of stuff, like if I want to ask you, for example, I want to ask you standard error, but I might ask you what the RSE of the model is, or what is the R squared. Okay, so you looking at the regression output, can you identify these 5 or 6 key pieces of information? And the slides are fairly self-explanatory. Okay, and that's it. I think that's all I want to cover in terms of interpreting regression output. That pretty much concludes our review, and please email if you have more questions.